Many of us focus on getting a checkup for our physical well-being, but what about our financial well-being? Lots of people have built up negative emotions, attitudes, or behaviors towards finances. Today, we'll focus on taking control of our financial lives by performing a checkup in three key areas. When it comes to finances, budgeting might just top the dreaded words list. Budgeting often makes people think about limitations, tracking expenses, and ultimately cutting back. By reframing this as a spending plan, we can better reflect the control that we have and the choices that we can make in setting priorities and aligning our dollars with our goals. Let's look at two actionable ways we can approach a spending plan. First, a transaction snapshot. Many people get bogged down in the details when working on a spending plan. So let's start with a simple exercise. For this, you'll just need last month's bank statement, 4 different colored markers, and a calculator. First, highlight your beginning and ending balances with that first color. This is pretty easy. Did your account balance increase or decrease? That tells us a lot. Second, highlight all income or deposits into your account with the second color. Are they consistent or are there varying amounts? Do you see anything that's out of the ordinary? Add these up. It'll come in handy for our next exercise. Third color, highlight all of your reoccurring expenses. Those are the ones that don't change each month. Is there anything on there that you're paying for but no longer using? Are there any services where the price has crept up over time? For example, a cable bill or a cell phone bill that you can call and maybe negotiate a lower rate? Last color, look at what remains. It's time for us to do a little detective work. Highlight the category that occurs most frequently. Note, I didn't say the one that you spend the most money on, but rather the one that you swipe the most for. In my house, this is lunches out. Admittedly, I've actually felt embarrassed when I sometimes see how many lunches out our family has had. Is there an area where you feel like you might be out of alignment with your financial priorities? Sometimes just elevating that awareness helps you to rein in that spending. After you've completed the transaction snapshot, you're likely ready to focus on where those dollars are going. Here, you'll see an ideal budget. This is based on your take-home pay. That is after taxes, retirement plan contributions, medical insurance, anything else that's deducted from your paycheck. It's the number you calculated with that second color in our last exercise. The two areas that I often see folks overcommit to are housing and transportation. Housing would be rent or mortgage and taxes, plus homeowners or renters insurance. And that transportation category includes not only a car payment, but also gas, car insurance, repairs, registration, inspection, and any public transportation costs. While the percentages here are only guidelines, know that if you're overspending in one of these areas, then you'll need to take it from a different category to make up the difference. And unfortunately, if you're overcommitted, I often see the first two categories that are shortchanged are savings and charity. Keep in mind, since this is after contributing to your retirement plan, the savings of 10% that you see on this suggestion is for short-term and mid-term needs, things like a vacation or a home renovation. Another common question I receive is, what about childcare? What about student loans? Well, if you have childcare expenses or debt payments or any other category that's not listed here, you'll need to adjust these suggestions to make room in the pie. Ultimately, this is just one suggestion for a spending plan. You'll need to decide if certain categories are more or less important for you personally and adjust your own spending plan accordingly. As we move to think about long-term savings like retirement, I'd like to pause and remind you that while there are many factors involved in planning and saving for retirement, there are only a few that we are in total control of. We've already touched on your spending plan today, so let's shift now to your savings plan. First, let's consider how much you've already saved. Find your age along the left and your salary along the top to see how many times your income you want to have saved for retirement at each checkpoint. So for example, if you're 40 years old and earn $60,000, your checkpoint is 2 times. 2 times $60,000 is 120. This is a very high level checkpoint, and there are many great resources that are available from your retirement plan provider that can help you do a more detailed analysis of your current situation. It'll factor in things like your lifestyle, whether you're married, if you have a pension, and whether you intend to retire early or you want to work longer. If you find you're not quite where you want to be, don't fret. There are ways to catch up, but the key is to take action. And if you haven't started saving yet, this is the chart for you. Find the intersection of your age and salary. This is how much you should contribute annually going forward if you have $0 saved for retirement today. So for example, if you're 35 years old and earn $40,000, you should save 12% for retirement if you want to maintain the same lifestyle. Obviously, there are benefits to starting earlier. So if you can't contribute the amount you'd like today, the key is to just get started. If you find your savings are not quite where you had hoped, don't be discouraged. One of the easiest ways to close the gap is to just take it one step at a time. By increasing your contribution by just 1% each year, you can make a meaningful difference in your retirement savings. Continue to increase each year until you're satisfied with how much you're saving. A final reminder on the retirement plan, you already know that this is a long-term savings vehicle. So try to build up an emergency savings so that you can keep your retirement money protected and saved for the long term. If taking a loan or withdrawal from your retirement plan is unavoidable, try to mitigate the impact by continuing your contributions while you're repaying the loan. It's especially important to ensure that you continue to contribute enough to maximize your employer's match. Speaking of emergency savings, it feels like there are so many competing priorities in several different places to save your money. Where should you save first? We suggest starting by saving 3 to 6 months of expenses into an emergency savings. Then, if you're on a high deductible medical plan, your next stop is the HSA or health savings account. Ideally, you'd like to save 2 years worth of the annual deductible into that account. Next, your retirement account. Contribute at least enough to maximize any employer match contributions. Fourth, higher interest debts. Here, we're defining that as credit card debt or any other debts where the interest rate may be higher than 6%, like student loans. Once you've cleared those debts, yay, what a relief! Then you can turn back to the HSA and the retirement account, each of which have their own annual contribution limits. If you've maximized those accounts, you may consider making additional payments on debts that have lower interest rates, less than 6%. Finally, as you continue to climb toward the top of our priorities here, it's time to consider additional IRAs, traditional or Roth, and taxable accounts, like a brokerage account or using an app like Acorns. Next, we'll shift to talk about protecting those assets that you've saved. When we think about protecting our savings and our assets, buying insurance often comes to mind first. New York State requires that you carry basic levels of insurance. And if you have a mortgage on your house, the bank's going to require that you carry homeowners insurance. It's important that you work with a trusted insurance professional to ensure that the coverage that you're carrying is appropriate based on your needs. If you're expecting insurance to cover the full amount of damage should an accident occur, you'll likely need to buy limits that are above the required minimums. And if you're renting, consider renter's insurance to protect your furniture and other possessions. If you own any fun toys like a boat, snowmobile, or maybe an ATV, consider whether you'd like to insure those as well. Finally, as your assets grow, you should consider purchasing umbrella coverage, which steps in if there's a catastrophic event that your policy does not cover in full. Ensure that your umbrella coverage is coordinated with other property and casualty policies. For life and disability insurance, First, you want to understand what is available through your employer. Let's dig in a little bit deeper. There are many factors when considering how much life insurance to buy and what type of insurance to buy. The key is to align with your other financial goals. Are you seeking to carry only coverage for a limited period of time? For example, until the kids are out of the house? That would steer you towards term insurance. If you have longer term goals like charitable giving or leaving behind a legacy for your loved ones, then permanent insurance may be more important. Some individuals buy life insurance for reasons beyond the death benefit. For example, some types of permanent life insurance include accumulations of cash value or investments that you can use to meet other financial goals like retirement savings. Depending on what your goals are, the amount of death benefit will vary. Some people look at the amount they want to buy in terms of a needs assessment. Which debts do I want to pay off, or what expenses do I want to cover in the event of my death? Others take a more encompassing approach to sustain family lifestyle or to fulfill their desires to leave a legacy. The maximum amount of insurance you can purchase is also called your human life value, which is basically calculating the future earnings until your normal retirement date. Disability insurance is designed to replace your paycheck in case you're unable to work. Illnesses, not accidents, cause most disability claims. Short-term disability typically covers when you're unable to work for 7 to 90 days due to illness or injury. Long-term disability typically starts after 90 days. The length of coverage varies from policy to policy, so you'll want to know how long it will continue to pay you should you have a claim. 3 out of 10 workers will experience a disability that keeps them out of work for 90 days or more during their working career. Next, be mindful of the definition of disability under your policy. Some policies define disability as being unable to work anywhere in any position, while others define disability as being able to work in your own specific job. Some policies will pay you the difference if you're able to work, but it's in a lesser role or a more limited capacity. While New York State does have a state-mandated short-term disability insurance, the state benefit is currently limited to $170 per week. Social Security disability, which has one of the most strictest definitions to qualify for, only pays an average of $1,100 per month. You'll want to consider what level of protection on your paycheck is appropriate based on your household income needs. Long-term care insurance. There is a 70% chance that you will need some type of long-term care after age 65. Long-term care insurance can help alleviate both the financial and the emotional burden for your loved ones. A home health aide costs approximately $20 an hour, and private nursing home can range from $80,000 to $100,000 per year. Neither health insurance nor Medicare pay for long-term care services, and Medicaid will only pay if your assets are very limited. So while some individuals feel comfortable self-insuring this risk by way of saving more or relying on support from family members, many consider purchasing long-term care insurance to meet their needs. A good time to consider buying this insurance is when you're in your 40s or 50s, when premiums are more affordable. Long-term care policies often include much more than nursing home coverage, so you can opt to receive care in your own home if you desire. Long-term care insurance can bring peace of mind and dignity in case you need that care. If you want to learn more about life insurance, disability insurance, or long-term care insurance, Life Happens is a nonprofit organization dedicated to insurance education. They have many great calculators available on their website. Hopefully you found at least one item to take action on today. We wish you confidence and clarity as you continue to pursue your financial well-being.